Hello Sector Watchers, welcome to the show. This is the 102nd episode of Sector Spotlight for Tuesday the 26th of October, recording it on Monday the 25th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. As usual, if you've got any questions, feedback, reminders, whatever you want to share, please use any of the handles on the screen. For today, it is the last Tuesday of the month, and the regulars will know that that means that we're going to look at seasonality. We will also have a look at what's happening right now, so we do a review of sector rotation and asset class rotation as it is taking place right now. We will try to look ahead into the future with some seasonality data, and because we've been writing about offense versus defense, offensive sectors versus defensive sectors, I've pulled my beta spreadsheet out of the closet, updated it, and I am going to align that with current rotations and seasonality. So it's a full show. Let's start right away. Kicking off with the rotation for asset classes as we've seen it last week and the last few weeks. So daily rotations on the right, the weeklies on the left. Quickly look at the rotation of last week, then clearly a very good week for real estate and the stock market, up 2.5% and 1.6% versus the benchmark VBINX up 0.8% or 80 basis points. I think that's clearly a risk on week, and that's what we're seeing more and more in this market. If we look at the rest of the list, then we see commodities, GSG up 0.2 and DJP down 90 basis points. You see the tails moving into the weakening quadrant, coming from a long stint through leading. That's not damaging yet. Far as I can see, it's a pullback in the longer term uptrend for both commodity indexes. We see the tails for VNQ and ITOT moving into the leading quadrant. Stock market, ITOT leveling off quite a little bit over the last 2 days, last week. And then you see all the fixed income stuff moving into the lagging quadrant. If we put it in a slightly longer term perspective, then we see GSG and DJP continuing their long stint into leading on the weekly chart, so that's the reason why I'm judging those tails as intermediate, because the long-term tails are the weekly tails are very long at a strong heading, and they're well inside the leading quadrant. So based on the combination of these two pictures, I'm going to assume that GSG and DJP will eventually curl back up while inside the weakening quadrant. Of course, there's no guarantee, but that seems to be the most likely scenario. If we look at the tails for the stock market, then you see that ITOT is on a very short tail, went through a consolidation, correction, if you want to call it. However, still on the right-hand side, so that means that relative strength versus VBINX is still up, and it's now starting to curl back up just a little bit, but it is starting, and we see the strength on the daily tail. Same goes for real estate, a little bit higher on the RS ratio scale, but already picking up on the weekly and definitely picking up on the daily. And then we see GOVT and high yield all inside the improving quadrant and slightly rolling over. High yield not yet. Corporate bonds are already inside the lagging quadrant. And the US dollar continues to gain. It was not a super strong week for the dollar last week. It moved into the lagging quadrant, but the tail on the weekly is still very good. So just like for commodities, I believe that the US dollar last week went through a small setback, but the longer term trend is still for a stronger US dollar. When I quickly take a look at a few of those graphs, starting with the US dollar, and you can see that here's the dollar index, the US dollar, coming out of that double bottom that we mentioned here on the show, a little bit of trouble dropping back, but since 3-4 weeks, clearly above that 93 something level, and we came back last week slightly, but we're still holding up above those former resistance level that are now expecting to come in as support. And if we look at the euro-dollar charts, they're slightly more, give a little bit more perspective, I think. So here's the long-term chart. This is the big head and shoulders that we're working off. This is the neckline, the first neckline. The dotted line here is the neckline when you would use a close-only chart. You see the pullback. You see the break of the thick red neckline. So as long as this remains below 117, I think we're still in that downtrend that's underway, and the target is somewhere around 111, slightly lower. Push comes to shove, we could even see something going back to 119, where this neckline is, but that would be the lesser of the two scenarios. So for the time being, I'm gonna assume that US dollar or euro dollar remains below 117, and the next leg will take it below 115, 115.24, and move its way further down to the 111 area. Look at the daily quickly. Sorry, this is SPY already. The daily chart for US dollar. You see that a new declining trend channel is forming. You see the 116.70. I said 117. That's on the weekly. You see a little bit more detail on the daily. It's already starting to have trouble with that 116.70. So if that moves, then we can see a renewed move lower for euro dollar, which means strength for the US dollar. Looking at stocks and bonds, quickly look at ITOT, that is the broader stock market index, and you see that we are basically regaining our uptrend. We dropped out of that channel, so that's sort of invalidated now, but despite the fact that the trend is still up, it's got a slightly lower angle. But we are taking out the previous highs, all-time highs, and that's a bullish thing. So it looks as if ITOT is picking up, is re-entering its uptrend. It's also doing that on a relative basis because it's pushing to new highs on a relative basis versus VBINX. And the RS ratio line is still above 100, indicating that that uptrend is still intact. The fact that it is dropping indicates that the angle of that trend, the momentum of that trend, has slowed down a little bit, and that's what the green line is indicating. If we move to SPY, then we see a slightly, you see SPY is probably the chart that more people look at. SPY on the weekly also taking out its previous high. That's a good thing. The negative divergence that we had here in the RSI and the MACD, they're still there, but because of the dip that we had to 50 in the RSI, there's a good chance that we're now going to negate that divergence while moving higher. But we're not there yet, but there's a good chance that that will happen, and that SPY is also picking up, re-picking up its former trend, going higher. So it wasn't the corrective move that I was sort of anticipating, maybe hoping for. We've got to live with what we see on the charts, and that's that we're taking out the previous highs, and that the indicators and the rotations, they're all getting better and getting stronger, and it's something that you can't deny. I want to leave it at this for the asset classes and quickly move on to the sectors. When we shift our focus to the sectors, we have the daily RRG for sectors on the right, the weekly RRG for sectors on the left. Let me rank this on performance, and we see that discretionary, consumer discretionary had a very good week, followed by real estate, healthcare, financials, and energy. Energy, despite the fact that it is on a long tail going into the weakening quadrant right now after a massive move around, and you can still see it here on the weekly. We'll get back to that in a second. So here's financials, here's healthcare, here's real estate, and here's discretionary. Discretionary nicely making a rotation back into leading, so that's a very reliable move. That's a strong sign for the consumer discretionary sector moving into the leading quadrant. If we see what didn't do it for last week, is technology was in line with the market. Last few days rolling over. Industrials losing predominantly momentum, not so much in terms of relative strength. Materials losing momentum, still slightly picking up relative strength. Utilities down or up 1.9%, but that's below the market because the S&P was up 2.2. Picked up for the last few days. Staples clearly moving into the lagging quadrant, and communication services also moving into the lagging quadrant. If we bring that into a longer term perspective, and I'm gonna rank those tables on symbols so we can move them side by side. Then we have materials clearly picking up, although not a very long tail yet, not much momentum behind it, but moving in the right direction, and it's already in leading on the daily RRG. Go to communication services, that's going into lagging here as well. That's clearly not a strong rotation. Energy keeps amazing. It's a stellar move. There is an email in my inbox, and I haven't responded yet, and I have to admit that I haven't really read it, but I think the headline was something along the lines of, did you miss the energy trade? And I think the answer should be yes. Why? Because on a relative basis, it was for a very long time an underperformance, despite the strong price moves in absolute terms. I just wasn't very comfortable onboarding on that rally after such a long downtrend. And if you look at the longer term chart, then in terms of long-term trend, the energy sector is still in a downtrend. So I believe that despite the fact I missed a massive trade from the lows, if you could have gone in at the lows, there will still be opportunities to participate in any more meaningful moves in the energy sector. Financials been doing really well lately, lost a little bit, but you can see that the tail is already starting to flatten. Industrials picking up on the weekly, that's an interesting one. It's dropping here on the daily, but not so much in terms of relative strength. Technology moving into weakening at a weak heading, and here it's strong, so they're sort of offsetting. Technology not doing much. Staples is an interesting one because on the weekly it is clearly, that's the daily, so on the weekly it is clearly rotating back, and you see that very short tail that remains on the left hand side. That's an indication of a weak relative trend. And here you see momentum picking up on that negative move into the lagging quadrant. Real estate offsetting each other. Utilities, that's also another one that's clearly moving into lagging on the weekly RRG, and on the daily we had 2 good days. We'll have to see how that goes, but it was rotating back. Healthcare moving into lagging, and here you see it moving into improving, but at a low reading on the RS ratio scale. And here we see consumer discretionary pushing into the leading quadrant, and we already saw that tail moving. So all in all, and that's what I wrote my blog about last week, is that it looks as if offensive sectors are now kind of pulling away. And last week, after I wrote that article, I was thinking about it. What else can we do? What else can we see? What other information do we have? And a number of shows ago, I presented to you the offense versus defense, offensive versus defensive sectors, the way MSCI classifies those sectors. And because I couldn't really pinpoint what was going on, I decided to get my beta spreadsheet out of the closet and update it and overlay my beta values on those RRGs with offensive versus defensive sectors, because the assumption or the general thought would be that the cyclical and the offensive sectors, they would have high beta values, and the defensive sectors would have low beta values. That's the assumption. That's the way you would look at things. And we're going to have a look and see how that works out, and whether that is really aligned with those cyclical offensive classifications. The table on the screen shows you the 36-month beta for every sector. And as you can see, energy ranks the top at 177, which is super high, followed by financials and you can read the list, and then you got the typical defensive healthcare staples utilities at the bottom. Now, on this slide, these are the sectors, according to MSCI, that are cyclical, offensive cyclical sectors. Now I've added the beta value for every sector on the tail. And you can see materials and industrials, 107, 118. Industrials definitely, materials maybe. Financials for sure, discretionary for sure, communication services, real estate, 0.76. I don't think that that's a cyclical or an offensive sector, at least not according to its 36-month beta value. And technology with 104, just like communication services, that could be a debatable value. Nevertheless, the main takeaway of this chart, at least for me, the way I read it, is that the really cyclical stuff, which got a high value and is included by MSCI as a cyclical, that's financials, discretionary, they're definitely positive. They're moving into the leading quadrant at a strong heading, so that's a good sign. And now we got industrials at 1.2, which is also definitely a cyclical sector, and also maybe materials not so much, but at 1.1 it's as good as discretionary. So I think that these sectors here, they are definitely all can be classified as offensive or cyclical, and they're all moving in the right direction. The stuff here, debatable, but I'm not going to pay too much attention because the real cyclical stuff is moving in the right direction. Now on the next chart, we have what by MSCI is classified as defensive. And look at that. You got three sectors: staples, utilities, healthcare, 0.68, 0.47, 0.71. The super defensive. I mean, very low beta and classified as defensive. And everybody knows that utilities, staples, and healthcare are defensive sectors. But energy as a defensive sector, I can't really see that. I can't see that by that high beta value. So again, if you take out energy and say, hey, why are you classifying that as a defensive sector? I don't know. Sure as hell is not backed up by a low beta. Then you can see that all defensive stuff is moving into the lagging quadrant or towards the lagging quadrant. And that backs up the narrative, at least in my head right now, that offense is pulling away from defense. And I think that those two charts are making that pretty clear. If you look here, offense, discretionary, financials, industrials, materials, they're all pulling away. They're all moving towards that leading quadrant into improving towards leading. If you go to defense, they're all moving. This is probably even more clear. If you're not entirely sure about what you see here in terms of cyclical sector rotation, then this should be the trigger, because all defensive sectors are moving away. They're moving into the lagging quadrant. They're starting to or regaining their relative downtrend versus the S&P 500. So with the S&P moving to new highs and offensive sectors now clearly beating defensive sectors, I think that at least for the near term we're in for a new leg higher in the already rising trend of the S&P 500. Now let's wrap it up with a look at the seasonal patterns, the seasonal performance for the sectors, and see if we can find any meaningful alignment with current rotations. If we look at the seasonality chart, the way I started using it, by the way, if you're interested in this spreadsheet, drop me an email and I'll be happy to share it with you. If we look at the seasonal percentages, so the number of months where the sector outperformed the S&P 500, then we're looking for really high numbers. We've got a high number for materials. 70% of the months of November, materials outperformed the S&P 500. And definitely industrials. 90% over the last 20 years industrials outperformed the S&P 500. I think that's a meaningful number. 70 is good, 90 is really good. But also on the downside, which sectors have predominantly underperformed the S&P 500 in November and following? Because if you look at materials, December was 55, it's still over 50, so it's leveling off. So November, December is a pretty good period for materials. And also for industrials, of course, November is really good, but December is not wrong either. Now for the downside, we look at really low numbers. And we find some here at energy, which in 35%, only 35% of the months outperformed. That means that in 65% of the occasions, the energy sector underperformed in November, followed by 60% outperformance in December. Now the highest number here is for real estate, 32% of the months only, so that is 68% of the time real estate is underperforming, and then it's going into a reasonable December. And you see utilities, 65% of the time underperforming the S&P 500 and also going into a decent December. So please don't focus too much on those November numbers. It's probably not an exact month. And you know, I'm working on a project to make that more gradual, and I hope to be able to show you that hopefully the next month. Actually, that would be really cool. So what numbers are we looking at in terms of outperformance or underperformance? So for materials and industrials, the two sectors that are showing a very high odds of outperforming the S&P in November, historically, materials has outperformed the S&P 500 by 1.5% over the S&P 500. And for industrials, the number is 1.4. And you can see that also December for both sectors is a pretty good month. If you look at the figures for the sectors that are not showing a strong seasonal pattern, or they show a strong seasonal pattern but the other way around, is that energy on average has underperformed the S&P 500 by 80 bips in November, and real estate and utilities have underperformed by 1.5 and 1.2. What you see is that the ones that have been underperforming come back pretty strong in December, especially the real estate sector. So from a seasonal pattern, energy, real estate, utilities are dipping and then picking up. And if you look at the strong ones, they are strong and sort of remaining strong, I guess. Now, if we put that on the new visualization that I presented to you, started presenting to you a couple of months ago, you see the same figures just visualized slightly differently. So here is the materials sector with 68. This is updated a little bit further, so the numbers can be off a little bit, but not by much. And you can see here that materials, 68% of the months, it outperformed the S&P 500 with 1.3 relative return versus SPY. That's according to what I just showed you. So materials is definitely a sector to keep an eye on in November and then going into December. The other one here, and 89 is 90% in my spreadsheet. 89% of the months, industrials outperformed the S&P 500 with an average return of 1.2%. So these are the big greens, the fat greens. Those are what we're looking for. Fat greens and thin reds. That's what you're looking for on this chart. And we got industrials and materials 68 and 90%, and both 1.2 and 1.3% expected outperformance. So that's pretty good. On the negative side, we have energy at 32% with an expected return 1% below the S&P 500. And we have utilities at 32% with an expected return of 1.6 below the S&P 500. And we've got real estate at 32% with an expected return of 1.5 below the S&P 500. I think these are quite meaningful numbers. So let's switch to an RRG and see how the current rotations for these sectors align or do not align with the expectations from these seasonal patterns. So here's the RRG for the sectors, and let's have a look at the strong sector. So that's materials, and you see that this tail starting to pick up and moving into the improving quadrant, and industrials is almost on top of it. If you look at those two tails, especially the last few weeks, they are almost on top of each other. So that's reasonably good. It's pretty aggressive, but it's reasonably good, and it's backed up by strong seasonals. Now let's look at those charts. So you see materials is pushing against resistance. Clearly, if that breaks, that's an extra push, that's an extra positive for the materials sector. If you look at the chart for industrials, we see a similar picture where it's in a trading range, came out of a range, out of its trend channel, went into a range. Again, if we break this range on the upside, there will be an extra impulse, an extra positive sign for industrials. So I'm pretty convinced that both materials and industrials are looking ahead at a good month of November. It's backed by seasonality and it's backed by strong rotation, and we can get the confirmation in the price charts if they break to new highs. Now on the other side, we had that negative expectation for the energy sector. Now look at this tail, that is massively positive. And if you look at the chart for energy, that's not a bad chart. I mean, yeah, we looked at it a lot and maybe I did miss the trade, but this is not a bad chart. So I'm gonna neglect that negative seasonality for the energy sector. So I'm just basically gonna ditch that because seasonals and actuals are contradicting, and that makes it a difficult call, if not an impossible call to make based on the combination of those two facts. If you look at real estate, it's still on the right hand side, it's leveling off, picking up a little bit. So in terms of seasonality suggests that it is a weak sector in the month of November. We had some sort of a correction here, we're not pushing to new highs. This is not the strongest of tails, but it's not super weak either. So I mean, energy is very clearly a no-go. Real estate, it's debatable whether this is a really negative sector or not. So I'm going to leave it at that. But the last one, that's utilities, on the weekly, through improving, back into lagging. And if you look at the price chart, then that's not super negative, but it's not very positive either, and it's already pushing against resistance. So on the downside, on the negative side, I'm going to go with the utility sector because it's rotating back into the lagging quadrant and it's not a super strong chart on the price chart. So utilities is definitely a weak one. If we wrap all this up, we get the next table. So industrials and materials, strong seasonality, good to strong RRG, high beta, cyclical, pretty high conviction for those two sectors going into November. Energy, too much contradiction, very high beta, low seasonality, good RRG, debatable. I'm not going to go for it. Real estate, debatable, negative, RRG sort of neutral, low beta. So that could be a negative for November. And then we got utilities, that's a strong sign. You got negative seasonality, you got a negative RRG, and you got low beta, offense, defensive, remember what we talked about. That's a high conviction on the downside. Ladies and gentlemen, this wraps up Sector Spotlight for this week. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. And I'm looking forward to see you back next week, same time, same place, here on StockCharts Television.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.